I belong to you.
My name Helmcamp. Y'all know who I am. Started BWC back in 2019. We'll talk about. We always like to talk about rates because, especially right now, because it's top of mind. It seems like everybody's talking about it. Yesterday, the Fed made their announcement to raise interest rates, short-term rates, by a quarter. That has been expected for some time. They did confirm they intend to continue raising rates at least 4 to 6 times over the course of the next year. So we do anticipate them to continue to raise short-term rates. They're doing that primarily to fight inflation. Whether or not they'll be successful remains to be seen. So we'll just have to see. The big news that came out yesterday as a part of that rate increase, which was expected, was they said that they intend to reduce their balance sheet at a future meeting, but did not provide any clarity as to which meeting that would be or when that would be. And in the mortgage world, that's what we've really been waiting to find out, because they own a lot of mortgage-backed securities, a lot. Between mortgage-backed securities and treasuries, they have about over $7 trillion, which is a ton. If you go back to 2008, they had less than $1 trillion on their balance sheet. So that number really, and as a matter of fact, at the start of the pandemic, it was around 3 trillion. So it's gone from 3 to 4 trillion in the last to 3 to 7 trillion in the last 2 years. And so that's a really big number. If they sell a lot of mortgage-backed securities in the market, that's going to put more upward pressure on mortgage rates. So as you're talking to your home buyers, what I'm communicating to them right now is rates right now are in the mid 4s on a 30-year fixed. At the beginning of the year, we were in the low 3s. So they've gone up very quickly. It's the fastest increase I've seen in my career in 20 years. I'm hopeful that we level out here. And the good news is today we're seeing some positive movement in the mortgage market. So hopefully we'll level out and trade in the mid 4s. But I'm telling my clients, I think one of 2 scenarios are likely. A, if you're in a position to buy and you're ready to buy and you can get a house under contract to buy, let's get you locked in. Let's get you in at 4.5%. If the Fed is unsuccessful in fighting inflation, long-term rates are going to continue going up, and you'll be really glad that you locked in a 4.5 rate when rates are 5 or 5.5. Okay, or they're going to be successful and raise short-term rates. We go into a little bit of a recession. Longer-term rates are likely to come down. We could be in a position to refinance your mortgage at that time. So regardless of your situation, I think one of those 2 scenarios is likely going to be the case. If we get you qualified, let's get you into a house now. So I just had a really successful meeting earlier today with a first-time homebuyer couple, and they felt much, much better after having that conversation. Okay. All right. So that's rates. You guys joined today because and the primary goal for this meeting is to show you how I interact with your clients. I want you to have a good idea of how I conduct all of my first-time homebuyer or all of my homebuyer meetings, whether they're first-time homebuyer, second-time homebuyer, et cetera. And today I have Corey Turner on my team, who's here in the top left-hand corner on my screen. I'm not sure where he is on yours. He's going to play the homebuyer. Corey joined me about 6 months ago. Corey, tell him who you are.
Yeah, hi everybody. I'm Corey Turner. I am a mortgage loan officer. I work with the team here at BWC Lending, and I'm excited for you guys to kind of get a little bit of a glimpse behind the screen and see what we go through each and every day with our buyers. So this should be a good training.
Excellent. So I'm teaching Corey, and I get to hear Corey on his loan meetings with clients every day. And so it's been a fun process for him to get to see how our business operates. And so we're going to use him as a prospective home buyer. And so I'm just going to treat this like a normal loan meeting, so you see exactly how I interact. And then at the end, if you guys have questions, concerns, feel free to interject as well. Hey, Chris, do we have the chats up and running? I see you're sending out chats. If you guys want to put message in the chat box as well, feel free to do that. All right. So I always start by sharing my screen. Mr. Turner, here is how our clients' applications look on our side. So Corey, I have your loan application here. I always start by validating their information. Corey, I've got your social 111111112. Is that accurate?
Chad, I must have bumped my head before I filled out this application because my social is actually all ones. So that two needs to be replaced.
Okay. All right. Well, let me make that correction. I'm glad I did that because it's amazing how many folks transpose a number on their social security. And I'd much rather discover that now than when you go under contract and then we repull your credit only to learn that maybe we had some inaccurate information. So thank you for helping me clarify that. All right. Date of birth, 11/24/86. Does that look accurate?
That's correct.
Okay, perfect. And you currently live at 10497 Town and Country Way. And I'm showing that you've been there about 8 years.
Yes, sir.
All right, $1,200 a month rent.
Yes, sir.
Unmarried, no children.
That's correct.
We got commitment challenges. Is that the deal?
We have commitment challenges. Yes, we do. Thank you.
All right.
Thank you for pointing that out.
Okay. All right. Good. Okay. Perfect. All right. Okay. And you are currently working with BWC Lending. You've been you've been in this line of work for 4 years, but you just started with BWC back in October. And you've got a very nice, generous base salary. It looks like they're paying you a little too much. Is that $10,000 a month?
There you go.
Is that right? Okay. All right. Good company. All right. Okay. Assets. Oh, wow. Look at this. We've got quite the little saver here as well. So we're looking really strong on the asset front. We've got 45,000 in checking, 350,000 in savings, and about 500,000 in retirement. Does that all that sound about accurate?
That looks good, Chad.
All right, man, doing great. Okay, good deal. Okay, all right. Now liabilities. Ooh, looks like we've got a nice car, nice Tesla payment of about $928 a month, and a Capital One credit card of about $25 a month. Is that accurate?
That looks right.
Okay, must be good. Must be nice. Okay. All right. Well, let me go ahead and pull up your credit report because I always like to review the credit. Let's see. And then we've got Tesla. Okay. Almost got it paid off. Okay. 13,920. So as you can see, we've sort of dummied this up a little bit. This is not the actual credit report. But what I always review their credit. Invariably, with every client, we find something that may or may not be an issue, whether it be a credit card that's also almost maxed out, or we have a collection account, the collection accounts in particular. And if they have any credit issues, we'll immediately go and to my what if simulator, and we'll run the what if simulations to see what we can do to improve their credit. But Corey does have fantastic credit in the real world as well. So he's in great shape, in good shape to do what he wants to do. All right, perfect. So then I'll hop back to the front page here. So right now, Corey, we have you pre-approved for a $400,000 purchase price, assuming 5% down. When we go through a pre-approval, we're looking at 3 things: income, assets, and credit. And right now, you're really strong on all 3 fronts. So you're a great first-time home buyer. For a $400,000 purchase price, I'm showing that your housing debt ratio is about 30%, and your total debt ratio is around 39%. If you read a book about buying a house, it'll typically say that if you want your housing debt ratio to be in the 28% ballpark, and that your total debt ratio to be around 38%. So in our world, 30 over 39 means you're really in the right ballpark, and this is a good price point for you. That said, you have really strong credit and really good financials. And so realistically, and you could put more down if you wanted to. I just want to kind of show you, if we increase your price point, what happens to your debt to income ratio. If we go up to 500,000, now we're at 36 over 46. With your strong credit profile, you would probably still qualify here. But at the same time, I try to encourage my clients to keep that back-end debt ratio at least below 45. Although it's not uncommon for us to get approvals all the way up to 49% on a conventional loan. And then if somebody's looking, let's say if they have more credit challenges and we need to go FHA, we can get debt to income ratios all the way up to 57. That makes me a little uncomfortable, but some clients do qualify there. So, Corey, do you have any questions on any of that?
No, sir. I think that looks good. I appreciate you. The debt to income was my biggest concern, and it's good to know that I'm in line with where I should be at a $400,000 purchase price.
Yes, you're in great shape there. I think that's good. Now the challenge is finding that $400,000 house, in River Oaks. Good luck with that. Okay, all right. Well, let's go ahead and look at some loan options real quick. Give you kind of an idea of what to expect. Corey, I've worked up a number of different options for you for a $400,000 purchase price, showing you varying different degrees of down payment. Okay, so on the left, you've got 5% down, second column 10%, 15%, and 20% down. Okay, you'll see the interest rates here, 4 3/8 up to 4.5. What a lot of people don't know is that Fannie Mae actually gives you a little bit better pricing when you have a loan with mortgage insurance versus one without. Depending upon the price point and depending upon the day, sometimes there may not be a difference in the interest rate. Sometimes there is. And so as of today, there was just a little bit of a difference in the interest rate going from 15% down to 20% down. And so you can see the rate goes up just to 4.5 at 20% down. The monthly payment you see here is all inclusive, principal, interest, taxes, and insurance. We'll break those down in a little bit more in just a second. And then the cash to close is going to be all inclusive, down payment, closing costs, taxes, and insurance. Do you have any questions or concerns on anything that you see right here?
No, I think it's interesting. What stands out to me is the difference between the monthly payment between 5, then going to 10, then going to 15. The difference is not all that much when you compare it to the cash to close. That's quite a big number when you're looking at 31,000 at 5% down versus 51,000 at 10% down. It's quite a big jump, and your payment is only changing by $121 a month. So that's interesting. I'm glad you shared these options with me.
Absolutely, and I'm glad you pointed that out. As I've always try to point out to my clients, because I think most people, a lot of people think you have to put 20% down to buy a house, number one, and it's pretty funny how that myth is still out there. Obviously not the case. You can put as little as 3% down as a first-time home buyer. If you're a veteran, you can put as little as 0 down. But in your case, yeah, you can dramatically increase your out-of-pocket expense. And I just worked with a client a little earlier today where they had some debt-to-income ratio challenges. Well, he was planning to put 15% down. Well, I automatically showed him he could put 5% down and pay off 2 liabilities that have much larger monthly payments than he's benefiting from putting 15% down. His cash flow is going to improve dramatically. His debt-to-income ratio is going to improve dramatically. And that's what's nice about the way we approach this, is we're able to really kind of dive into people's finances and put them in a better cash flow situation as well. Your cash flow looks to be in really good shape, so I don't think we have to do anything there. It's just going to be up to you and your comfort level of where you want your cash to be. All right, so let me click on the More Info tab, and we'll dig into these numbers a little further. Okay, so here's your monthly payment. If you were under contract today, the numbers I know to be accurate would be the principal and interest and the mortgage insurance. Okay, so I can price those out. I know exactly what to expect there. You can see here too that the PMI, when you have really strong credit, is not terribly expensive. So these 3 options with less than 20% down, not the end of the world if you decide you want to hold on to a little more of your cash. The hazard insurance you see here, I've got guesstimated as at $250 a month. Hazard insurance is just another term for homeowners insurance. This number can vary wildly based on the company you choose, the coverage you choose, the home you buy. There's just a lot of details that go into it. I think at this price point, this is a good number to budget for. Candidly, it's probably a little high, but my goal is always to err on the high side. I hope that as we go through this process, our numbers get better, not worse. And I would say most of the time that'll be the case. And then lastly, we've got property taxes. So I talk a lot about property taxes because taxes vary so much around town. I know you're looking to buy in town, and in town tax rates are usually going to be in the 2s, ranging from about 2.3 to about 2.6%. What you're looking at here is a 2.5% tax rate, and it is based on the assumption that it is taxed at the sales price. And we'll dig into that a little more, but I have not factored in any exemptions. Corey, are you familiar with what a homestead exemption is?
I am, but maybe you could explain it to me again.
Okay, that's good. Be happy to. So when you buy a primary residence in the state of Texas, you can and will qualify for a homestead exemption. And the homestead exemption can be a very meaningful number. Where you're looking to buy, it's going to save you roughly 20% off your taxes, which is one of the more favorable exemptions in and around town. If you decide to buy in the suburbs, like let's say Katy or Pearland or some places like that, some of those areas and some of those school districts don't provide as big of a homestead exemption as HISD and Spring Branch ISD. So it really just depends on locationally where you buy. And so if you decide to move out to the suburbs, just please make sure you let us know so we can make sure we're budgeting our taxes correctly. When you move out to the suburbs, tax rates can go as high as 3.8%. And that can have a really big impact on your payment and your debt to income ratio. So just keep us in the loop there. But today we're using 2.5%, and 2.5% is a pretty conservative number for where you're buying. And again, the homestead will probably bring that number down by probably $150 to $200 a month. Okay. Any questions on the monthly payment or taxes or anything else?
Chad, I've always heard people talk about mortgage insurance, and everybody seems to be afraid of mortgage insurance. And here I am looking at these options, and I see that at 5% down, the mortgage insurance payment is only $66.50 a month. So, my question to you would be, is this have anything to do with my credit? Why is that payment so low? Because I was expecting it to be much higher.
Yeah, so the best thing about a conventional loan is conventional loans are very credit score sensitive. And once your score goes above 760, you're going to qualify for the best interest rates and the best mortgage insurance rates. And so your mortgage insurance premium is very, very low because you do have really great credit. Once that credit score drops below 740 or 760, every 20 points it drops below 760, that PMI is going to become more expensive. And depending upon the price point, and right now FHA loan limits have increased a lot. And so realistically, if you bought a $400,000 home, if your credit wasn't in really great shape, let's say you had a 660 credit score, usually once that score drops below 700, the conventional loan would no longer be the better way to go because FHA is not nearly as credit score sensitive. The PMI rate would be way better on a FHA loan with a score at 660. So 700 is really that mark where I see that it's depending upon the circumstances for the client is when FHA starts to come into the mix. Does that help?
Yeah, and the mortgage insurance, will that be on the loan for the life of the loan?
On FHA, it would be, but in your case, no. And so what's nice is in this software that we use, if you see at the bottom here where it says payment stream, you can click on this link here, and it shows you when it'll fall off. Okay, and this is based on the normal amortization schedule. It assumes you don't make any extra payments along the way, and it assumes you don't ever apply to have the PMI removed early. One of the benefits about a conventional loan is if you've been in the home for 3 to 5 years, and let's say homes continue to appreciate at the level they have recently, in all likelihood, you may be in a position to where you could apply to have the PMI removed early. I would say most of the clients we work with are usually reaching that point somewhere between year 3 and 5 over the last 10 to 15 years. Okay.
Thank you.
All right, perfect.
More about when, like different down payments on FHA, you get different mortgage insurance rates.
Okay, so y'all can't hear that because Chris is asking me questions. She can see me. She's sitting right over there. She asked a really great question on mute. And so basically what she said is, could I talk about FHA and the different down payments and how that would impact the mortgage insurance? And so on FHA, there's not a huge incentive to put a lot of money down on an FHA loan, but with FHA, the mortgage insurance will last over the life of the loan. The one benefit about FHA mortgage insurance, though, is as you pay the loan down, every year the payment goes down a little bit. The mortgage insurance gets a little more cost effective, whereas you compare that to conventional, this PMI you pay will be static over the life of the loan until it falls off. So it will go away someday, but it's going to stay the same. Whereas FHA, the mortgage insurance factor we use for FHA is 0.85% when you put 3.5% down. When you increase the down payment to 5%, it goes to 0.8. So it's not that much better, but it's a little bit better. And then when you go to 10% down, the PMI factor is still 0.8, but the benefit at 10% down on FHA is the mortgage insurance will drop off after 11 years, which is a really, really long time. And as I tell a lot of folks, it's not too commonplace that a client's in a home that long to realize that benefit. But it could happen. And so I do, and I've got a client I'm working with right now. They are doing FHA 10% down, and that MI will go away in the future. Thanks for the question, Chris. All right, let's talk closing costs. Okay, so closing costs. Normal closing costs are usually anywhere between $4,000 and $5,000, labeled here as APR costs and non-APR costs. APR costs means they're costs associated with the loan. Non-APR costs means they're third-party charges such as appraisal, title, survey, things like that. Okay. And then if you go to the prepaid items are going to be your property taxes and homeowners insurance. I would say very commonly what we hear in our industry, as a mortgage lender, it's always frustrating because I like to really distinguish between what closing costs are and what taxes and insurance are, because taxes and insurance are not closing costs. Yes, they're part of your closing, but they're not closing costs. They're things you've got to pay for no matter what, regardless of who you work with. And so we call them settlement charges. And so these are closing costs, $4,000 to $5,000. Prepaid items would be taxes and insurance. And of course, these are going to vary quite a bit depending upon how much your taxes and insurance vary. And then if I click on the fee detail, that'll give us an itemized breakdown of all the expenses. Okay. So everything's here, very transparent, don't want anything hidden. As I tell people, my goal is always to err on the high side. And in here we have 4 fees that sometimes may or may not apply. The survey fee of $495. If the seller has a survey we can use, this figure would likely go away. Power of attorney review fee. This is typically for when we have 2 borrowers where one borrower may or may not be able to be present at closing and the other one has to sign on their behalf. We'd have to have a power of attorney prepared, and our attorneys have to review that. Then we have a final inspection fee of $225. This is usually more for new construction homes. So it's not very commonplace that an appraiser has to go out to the property more than once, but that's what this is. If the appraiser's got to go out there to verify that the home is complete, and or if there were repairs that we have to verify were completed. And then lastly, the HOA transfer fee. Corey, you're looking to buy in town, not a lot of HOAs in town. So if there's no homeowners association, there will be no transfer fee here. Okay. And Corey, I'll tell you this, that my estimates here are based on the assumption that you're buying a resale home. If you buy a new construction home, every builder is different. Every builder handles who's going to pay for what differently. So I would just say, keep me in the loop if you end up leaning towards new construction. Let's make sure we identify, because there are some other costs that you may have to pay for if you end up going that route. And also with most builders, a lot of builders have preferred lenders. I tell everyone, find out what their preferred lender's offering. All I ask is, please show me what they're offering. If I can meet it or beat it, I will. If I can't, I'll wish you well and tell you to remember me the next time you buy or refi. Okay. Any questions on any of the fees or closing costs? Any concerns?
Chad, I would just ask you if you wouldn't mind going over that prepaid line item again.
Okay.
Is that my escrow account?
It is, absolutely. So when you go to closing, there's 2 things that occur. Number one, you're going to pay for your first year's homeowner's insurance at closing. And so right now we're estimating that at about $3,000 a year. In addition to your first year, you have to pay 3 months into escrow. Okay. So the goal of the mortgage company is to collect, let's say we were closing today, March 17th. Your first mortgage payment would be May the 1st. So what we're going to do is we're going to collect 1 month for April, since we're not collecting a mortgage payment in April. And then we're going to collect about a 2-month cushion. Okay. And then for taxes, we're collecting 3 months worth of taxes at closing. At the end of the day, because we're building an escrow account for you, and if we were closing right now, we would end up collecting 1, 2, 3, 4. We would be collecting 6 months worth of taxes to go into your escrow account, but the seller is going to give you a credit for their portion of the year, which is about 3 months. So the net impact to you is going to be roughly 3 months. So that's why whenever I'm working up my numbers on the front end, I calculate 3 months worth of taxes, because that's going to be about how much you're going to be paying. That make sense?
Makes sense.
Beautiful. All right. So just on the surface here, Corey, looking at these loan options, can you tell me if any particular one appeals to you more than the other?
Yeah, like I had mentioned, kind of when I first saw these 4 options, I think I really like the 5% down option versus 10, and because that's where I was in between, and I think keeping $20,000 in pocket for my payment to just go up by $121 a month. That makes a lot of sense to me. I know that there's a repair to the kitchen I'd like to do, and you know, I got to buy some furniture. So I like the option of putting 5% down, and that's the one I'm going to go with. So now I'm going to go get a house.
So okay. So you're going to replace that that bachelor pad black leather couch?
Yes. Yeah.
Nice.
Gotta get me a.
It's about time. It's about time.
Yeah. I hear IKEA has some good stuff. So.
Perfect. Beautiful. Okay, good. Well, great. Well, Corey, I appreciate your time. I'm glad this was beneficial for you. I tell you what I'm going to do. I'm going to type up all my notes. I'm going to send you an email along with all the notes from our meeting, these loan options we just talked about. It's very easy for me to work up these numbers. So as you narrow in on a home, send me the address. I'm happy to work up the numbers for you and send you a specific pre-approval letter for that option. But let me just show you what your email is going to look like. Ooh, hold on a second. There we go. So this is what the email is going to look like. You'll have your pre-approval letter. We have a client packet here. In this client packet has our do's and don'ts. The top 10 I'll call them the 10 commandments. So please make sure you review those thoroughly. And if you have questions, let us know. And then again, we'll have all of our goals and objectives down here at the bottom. And here's the link to view those loan options. When you click on the link, just gonna click on it real quick. It'll pop up like this. Again, all you got to do is click on the More Info tab here, and you can click wherever you want. And then also at the top left-hand corner, you can print them if you like. Okay. And I will also, who's your agent, by the way? Are you working with Sandy McNeil?
Yeah, I see her waving over there. So okay. Yes, Sandy.
Okay, perfect. Well, I'm gonna send Sandy an email that looks just like this as well, with notes from our meeting along with your pre-approval letter. Okay.
Thank you.
All right. Well, Corey, I appreciate your time, and we'll talk soon. All right, guys, that's it. That's how I do it. And I will tell you, most of my meetings are about that length, maybe another 5 or 10 minutes, because people obviously have more questions and things like that. But I try to keep it short and sweet. Sometimes I dig into taxes a little deeper. And so I'll go and I'll pull up, Harris County's website, and I'll pull up, the specific property they're looking at, maybe in the zip code they're looking at, because everything can vary so wildly. Do you guys spend much time looking at taxes with clients, or do they ever ask you questions about taxes with clients? A little bit?
They don't usually ask me too much about it. They just ask about the tax rate, but they're oblivious to so much of it. They have no idea how much of it goes to actually the school districts, the MUD districts, anything like that. They don't understand. They get totally confused when they have to sign the MUD form.
Yeah.
Thinking, oh, you told me this was the only tax. Yes, but this is going to come out in a separate document when you receive the bill. So we have to notify you of it, but it's still wrapped into that tax number. So yeah. I actually spend a lot of time explaining that to him. And I actually spend a lot of time on my net seller sheet explaining the prepaids. So I'm glad you really tell them about it, because I encounter a lot of people who seem to be clueless about what are these prepaids.
Yeah. Yeah, people do really struggle with it. And when you get a loan estimate or a closing disclosure, there's just so many numbers on it. And I know it's overwhelming for clients. And, we try to, I like to be transparent, but then I really just try to come back and focus on the high points. Are you comfortable with the payment? Are you comfortable with the cash to close? And then usually, like in Corey's case, I showed him different down payment options. With most clients, I'll show them an option at 4.375. If they're tight on cash, I'll show them an option at 4.75, where I provide them a credit towards closing costs to help minimize their cash out of pocket. And if they're not going to be in the home very long, a lot of times people will choose that option because it's the better way to go. Whereas conversely, if I've got somebody that says, Chad, this is it, we're going to be here for 10 plus years, I'll show them options with points so they can sort of see that break even. And because the break even on typically a 1% discount point, you're going to break even in about 5 or 6 years. Okay. And just reverting back to the tax conversation real quick, I've got this gigantic spreadsheet I've created with all these different school districts, et cetera. But like, here's HISD. And so I tend to focus primarily on this part here. And, you know, I've got all the formulas built into my spreadsheet to show how the homestead exemption will impact their payment, right? And so in this case, a $500,000 house is going to lower their payment, you know, about $200 a month roughly. Okay. And then this morning I met with a couple and they were looking at Katy. So tax rates fairly similar. So let's say if it was 500,000, you can see the tax benefit savings in Katy is not nearly as substantial as in Harris County, $77 a month versus $200 a month. And that's primarily because Katy ISD gives you 25,000 off. HISD gives you 20% plus 25,000. And then this one, of course, has the MUD tax, and most MUD districts do not give any homestead relief. Some do, but very, very few. Okay. Any other questions or concerns that anyone has that I can answer, or anything else you'd like me to show you? Don't all talk at once. No, nobody in the chat. Okay, well, perfect. Oh, okay, Britt, I just saw your comment there. Did not know PMI stayed for life of loan. Yep, that's a common misconception. And what's funny is some people think that they take that deal, that life of the loan applies to normal mortgage insurance, which it obviously does not. And so, and depending upon the client, like we have, you know, documents that show people how to remove PMI, and, you know, if some clients will ask me more on that, we'll share that information as well. But we've recorded this today, so we'll have a copy of this. So if you think anybody would benefit from watching it, please share it with them. But Chris will send that out to everyone. We'll send you kind of these details just so you have them for you. But we, of course, would love to work with your buyers, and now you know what they'll experience should you send them our way. So hope you feel comfortable to do so, and we look forward to working with you on the next one.
I belong to you. I belong to you.